All right, everybody. Welcome to Beau Benjamin Realty Group's 2023 Financial Summit. I appreciate everyone joining or watching the recording after the fact. And I'm going to kick this off. The reason that I wanted to do this and have this idea was because I know personally I've had people that, or I've had moments in time where I know I need to get things done in life. As you age and life changes, we know that there's things we need to be doing. Unfortunately, whole nother conversation, but our high schools don't always teach us how to budget and how to do things and get a state's plan, wills made, do our taxes whenever we can't use TurboTax anymore, and we have more complex situations. So that's the reason for this summit. We want to put you in touch with people that are professionals in their fields and that know what they're doing and know how to help you. So if you know you've had things you need to do, but you just didn't know who to contact, my goal is to make that one step closer. So we're going to put you in touch with those people, and now it's up to you to take those conversations offline and get your financial life in a better spot than it is today. And with a couple meetings post this call, I think you'll be in a great spot. So with that summary, that's how this will go. So we're just going to kick it straight off, about 10 minutes each person. And we're going to kick it off right away with Mr. Jeff Brown. He's a CPA locally here in Indianapolis. And one thing before you start, Jeff, if you're on the call and you want to make Jeff bigger, you just hover over his square and click the little pin, and it'll make him the focus of attention. And that's how the Google Meet works. So thank you so much, Jeff. I think you're on mute. Go ahead and unmute and kick it off for us.
Thanks, Beau. I appreciate you putting this together, having everybody here. A couple of topics I guess I wanted to cover are HSAs, 529s, and also talk about, I don't know how many business owners we have on the line, but S corporations as well. First thing I like to hit is the health savings account, which is referred to as an HSA. I guess in my professional opinion, if you don't have it at work, if you qualify for it, which most people do because it's based upon your deductible of the plan, which is very low, it's roughly $2,000 for a $2,000 for a single, or $3,000 for a family of a deductible. An HSA allows you a tax deduction on your return. It's not income limited, so anybody can take it. We're all going to need money sooner or later for medical expenses. The nice thing about it, it grows tax free. If you don't use it, you can use it later. You can invest it. You can put it in, make interest off of it, or you can put it into the financial market and let it grow. But it's the advantage of getting a tax deduction as well as something being taxed. In a sense, it's tax deferred, but it's tax free when you pull it out and use it for medical expenses. There is an option after you turn a certain age, you can pull it out like an IRA and pay tax on it if you want to. So I think everybody should have an HSA. The next topic is the Indiana 529. I see a lot of clients who have kids in either private school, parochial schools, or going to college that don't fund the Indiana 529. Early on, a lot of people got into other state plans because they were better performing than Indiana was. So Indiana came along with a tax credit of 20% to a max of $1,000 state tax credit if you funded $5,000 into your Indiana 529. That's kind of like making $20,000 of earnings on the state of Indiana and not paying taxes. So that can be used again for kids that go to college, any kind of trade schools after high school. A law a few years ago allows it to be used for private schools too, for kindergarten through 12th grade. The limit has increased for 2023 up to a $1,500 credit. So if you put in $7,500, you can get a $1,500 tax credit. Also, what passed at year end, you can also convert to a Roth IRA down the road. So let's say you have your 529, you don't use it all, you can convert it to a Roth. Right now, the rule says it has to go to the beneficiary of the 529, but there's a lot of unwritten or gray areas out there of what that beneficiary is and who it is. Can you transfer the beneficiary from your kid to yourself and still put it in? There is also a limit where you have to have the thing open for a certain period of time as well. So I think everybody should do a 529, especially if you're young. For example, I know my daughter, I think I funded $50,000 into it when she went to college. It was worth 80. So I made 30 grand tax free. Plus over the 10 years, I picked up $10,000 in state tax credits. So It's kind of a no-brainer, in my opinion. Or if you're a grandparent, you can do it for your grandkids. So if you live in Indiana, you pay Indiana taxes, 529 is a good option. The last thing is the S Corp. I see less and less, but still people are out there being sole proprietors and paying unlimited self-employment tax. They're huffing and puffing right now that to change that rule with maybe a potential budget plan coming out under the Biden administration and getting rid of the S Corp. But they've talked about that for a few years in the past. But there's an advantage where if you become an S Corp, you can limit the amount of self-employment tax you pay. You have to take a reasonable compensation to yourself. I'll give you an example. Let's say you make $100 grand. If you're a sole proprietor or a partnership or an LLC not taxed as an S Corp, you're going to pay self-employment tax, which is 15.3% on that whole $100 grand. If you can become an S Corp and we give you, let's say, a 30 grand salary, which is kind of a reasonable comp for a realtor, then you pay 15% tax on that 30 grand, which is $4,500, but the other 70, you don't pay that 15% tax on. And that's annual. So you can save over, $10,500 by being an S Corp every year. Take that money, fund a Roth, fund something else, fund your retirement, let that grow. But that's kind of the highlights of those three topics.
Thank you, Jeff. That's amazing. I had a quick question since we have a couple minutes to transition here. HSA you mentioned, can you start that outside of a company? I know.
Yes. You can have your own HSA.
So where is there websites to go to, or would you just contact you?
You can go to your local bank. Banks do them, or there's HSA Bank. There are online options. HSA Bank is one. I know I have mine at Old National, but they transfer it to UMB. But a lot of banks do have their own HSA that you can set up.
Interesting. And then there is a primary website, I believe, for the 529, right?
Indiana there is a website, and it has to be an Indiana 529. It can't be another state 529 to get that credit.
Perfect.
So,
all great information. I know Jeff helps me with my taxes, so fully refer him and ask that contact him for any tax questions, tax needs for your business or personal use. All right. We're going to switch gears to Tim Johnston. He's a VP of Financial Partners Group, and he's going to give us a couple tips from a financial advisor standpoint. Tim, you want to kick your session off?
Thanks, Beau. I really appreciate it. I'm going to basically piggyback on Jeff's comments, really about tax efficiency. I don't do taxes like Jeff does. We really try to grow money tax efficient, keep the IRS out of your pockets, and use that compounding of interest to our maximum ability. So a couple different areas that are really misunderstood from a lot of our clients coming in. The first of which is a lot of people think Roth IRAs are only for folks that make less than $200,000 for a joint household income. There's other ways around that now. So kind of getting around the income limits, you can do what's called a backdoor Roth IRA, where an individual or a couple will contribute to non-deductible traditional IRAs, and then the next day convert that to a Roth. The benefit of doing that, in our opinion, from a planning perspective, we see a lot of clients coming through our doors near the retirement age, and most of their investment assets are sitting in a traditional 401k, meaning that every dollar they pull out of those 401ks when they retire, or IRAs when they retire, is going to be taxable. So they deferred the tax, but they're not going to avoid the tax. Instead of putting all your money into an individual account, it's 1099 interest, has capital gains, and from when you're buying and selling stuff, you can use the Roth IRA as a very tax efficient vehicle because it never gets taxed. And by doing the backdoor Roth, you basically eliminate that income threshold that you got to worry about. For those folks that are in the higher income limits, again, they're maxing out their 401ks now. They're putting their $22,500 in there this year. Or if they're over 50, they're able to put 30 grand in their total. Most folks, again, are putting the money in the traditional 401k, so it's tax deductible. It's reducing their income tax. Most of the CPAs would agree that's a good thing. But after they hit that 401k limit, they kind of stop. And so mid-year, they're making, $200,000, $300,000, $400,000. Sometime in June, they no longer contribute to the 401k, so they get a bigger paycheck. What they can elect to do mid-year or in the beginning of the year is to contribute to a non-qualified 401k, which is additional money up near the $70,000 range until in 23. So you're contributing after-tax dollars to a 401k. It does grow tax deferred, But one of the unique things you can still do in most plans in 401ks is do what's called a mega Roth for conversion. So every year, every December, we help our clients convert that non-qualified 401k contribution, which is probably, between, all the dollars that can go in there, it can be up to $30,000 a year, which is significant. And you can convert those dollars to a Roth with no taxes. So you don't pay tax. We put that money in cash for that portion of the year, flip it into the Roth component, and then obviously invest the money for them at that point. So, to put away $70-something thousand a year on a tax deferred vehicle and half of that being the Roth component, that's really diversifying your assets from a tax perspective. So whether you are in a lower tax bracket when we retire, or if the government changes our tax brackets with our great debt that we're all carrying around, it's a way to be defensive, but also have choices. And I think choice when you get to retirement and tax efficiency is the key to keep your assets to survive. And then, from a real estate standpoint, Beau has put this all together. So a lot of our clients are looking at lending. They have homes, they have equity in their homes, but how do you buy an existing home if you're not going to build and do the construction thing, or buy an asset right away? The non-qualified assets we manage for our clients, and then we're not special. Merrill Lynch does it. Every broker does this. They have access to advanced loans on their non-qualified assets. So if you have $100,000 with us in non-retirement assets, you can access 62% of those assets via loan. Now, like everything else, interest rates have gone up. So a year and a half ago, those were around 3% loans. Now they're near 8%. So it's much higher, but they are short-term bridges, in essence, on your own assets. So you become your own bank. It doesn't hit your credit score. There's no real application to it from are you qualified? But 60% of your non-qualified assets, for most of our clients, is a significant number. So they can go buy the second home while, Beau or whoever's listing the home and trying to get their asset sold. When the house eventually does sell, obviously you pay it off because nobody wants to have an 8% interest loan out there. It compounds pretty quick. So we're doing that a lot. I mean, the homes have gone up in value for existing. A lot of people are still wanting to buy new homes to upgrade or downsize or whatever they're doing. And we're trying to give them access to liquidity without having to sell things and cost taxes or go to a bank and go through the whole underwriting process. So it's a loan advance program. Most major advisor firms have access to this stuff, whether they're independent or on the wirehouse side or the insurance side. So it's something to talk to your advisor about. There's no reason to be pinched or not buy the next home if that's your dream or your aspirations. So that's it.
That's awesome. I think I'll ask one question of you too. It may be a complex question, so just let me know if it's too long to answer on here. But you mentioned the term non-qualified assets a few times for people that are kind of noob in the industry or maybe starting out trying to figure out their financial advice. What can you define that more clearly? You said non-retirement assets as well, so I think it probably bleeds into that. But you want to spell that out?
So basically, any vehicle that you guys have that has tax deferral to it, where they're not getting taxed every year on the interest and capital gains. So whether it's the HSA, 529s, Roth IRAs, traditional IRAs, or 401ks, those assets cannot have loans against them. Now the 401k does have a privilege. You can take an internal if you're actively employed. We caution against that as much as possible because that's tied to your employment. And if for some reason you leave your employer for whatever reasons, that whole lump sum becomes a taxable event, and it's significant. It's very painful. So non-qualified stuff that is not deferred. So it's your savings account at the bank. It's CDs that you have at the bank. It's investments that you have invested with us or other advisors that is not tied to a retirement vehicle. That can add up pretty quick if you're really trying to get it done and doing planning. We can gather assets for you for a short term to get that max loan threshold. So you can go, whether it's a house or remodeling your kitchen or whatever, but it's really used for a short duration. We don't want to carry these loans. This is not a mortgage. This is, less than a year for sure. But second homes in Florida has happened a lot with us where people are beginning to transition down to Florida, but it's not full time yet. We're doing a lot of those bridge loans, if you will. So okay. Hopefully that helps.
That's excellent. Thank you for that explanation. We're cooking right along. We're a little bit ahead of time, but that'll just give more Q&A at the end if we need it. Third up is going to be Tammy Stevens. She's attorney with Stevens and Associates. So Tammy, if you can take the reins and tell us about what you do here in Indianapolis.
Sure. Good evening, everyone. I'm an estate planning and elder law attorney. I'm accredited by the Department of Veterans Affairs, and I'm certified by the National Elder Law Foundation as an elder law attorney. Elder law also encompasses special needs. Tonight, though, I'm going to talk about some more basic planning for estate planning that every person 18 and older should have good powers of attorney. When I was first starting my practice 30 years ago, we lived in a good old boy state. If you needed to talk to your parents' doctors, they would probably talk to you. If you wanted to talk to your sister's doctor, they would probably talk to you. If you needed to go to the bank and do some things with money, you might have been able to do it. But today, your rights are truly yours. So if anybody's going to change investments in a retirement account, if they're going to roll it to that Roth IRA at the end of the year, someone has to have authority to do that for you. So while you are capable of making your own decisions, you make your own decisions. The time that we don't know when we would become incapable is why it's important to do estate planning before you need it. So a power of attorney doesn't give your rights away. A power of attorney can be immediate. It can be springing, so it can spring into effect when you're incapacitated or be immediate. It needs to have backups. I can't tell you how many times I see clients who have named someone as their power of attorney who's younger than them, healthier than them, and that person gets in a car accident. That person has a life event that makes them unable to serve as power of attorney. The power of attorney works for you. So when a power of attorney is in place, the power of attorney works for you. Hopefully we're back. Works for you, and you can fire them. So if you got mad at your power of attorney, you have the ability to fire them. Another misconception that I see in my office a lot is going through probate. So what does a will mean? This last week, I had a family come into my office and they had a will. And the will says, leave everything to the two daughters. If the one daughter is deceased, which she was, leave it to her children. But mom put her surviving daughter on the bank account. Mom put surviving daughter as a joint owner with rights of survivorship on the real estate. There were not assets that were going to pass pursuant to a will. The will or intestate applies to those assets you have in your individual name that you don't have a beneficiary on. So it's important to know, especially I think more so as we age, it's important to know who we're putting on accounts and how that's impacting the estate plan. One thing that I see for younger couples is, or mid-age couples, all those remarrying, is they may own a piece of property or they may buy a piece of property together while they're engaged. Then they get married and they assume that property is joint with rights of survivorship. If the property wasn't deeded to them when they were married, or specifically say joint with rights survivorship, then it's presumed to be joint in tenant. It doesn't matter that they later married. It matters when the property was conveyed. You can easily do a quick claim deed after you get married, or you can title it originally joint with rights survivorship. Another thing that we've seen in our office a lot in the last couple of years, and it will become more important in future years, is the homestead exemption on real estate. So we see a lot of parents buy a home or own a home for their kids. Either their kids were bad with money and the parents bought the home. They may have bought it out of a foreclosure. They may have a special needs child that they buy a home for. If they own a home that their child lives in, they don't receive a homestead exemption on that property. If that property is in a trust and the child is the beneficial interest and lives in the property, you can file the homestead exemption. If the child owns the tiniest sliver of the house, you can file a homestead exemption. So we do a lot of 1% of a life estate, the tiniest little sliver that you can give to that child. You are giving them an ownership interest in the real estate. So when you want to later sell it, they have an ownership interest in the real estate. But that tiny sliver gets you the homestead exemption. In 2023, our mortgage exemption went away for real estate taxes. Our homestead exemption increased. So we will see that on our 23 assessed pay 24 tax real estate taxes, and it will become more prevalent at that point in time as you're losing other deductions. The homestead exemption is a 60% reduction off of the value of the home, capped at $48,000. So the new is capped at $48,000, but it's still a really nice reduction to the real estate tax amount. Another thing that we see is young couples worried about children. So the time that we see people do planning is often when they've gone through a bad experience with their own families, or when mom or dad is diagnosed with a condition that we know they're going to need long-term care, or we have new kids. So when new kids come on board, it is important to do planning. Again, we all hope that we're going to live into our retirement years, and we plan for that, but sometimes that doesn't happen. It's important when we have children that we have a will that actually designates who the guardian would be if we were incapacitated. It's surprising the fights that go on over kids. Sometimes it's because they worry they won't ever see them on the other side of the family. Sometimes it's because they want the kids' money. Sometimes it's they want the Social Security payment that's coming in for the kids. Sometimes they just love the kids, but there are lots of fights that go on over children if you haven't designated who should be guardian. When couples sit in my office, that's one of the points of contention. When I see points of contention, who are we going to name as guardian if we're gone? I tell everyone it's important that you have something named. It's important that you have a plan. It's important that you have a will. If you can't agree, you both do your wills and you name who you want to name, and the last man standing gets to name their guardian. So, if something were to happen to both, then we have a guardian named. So, also important to have a very simple minor's trust. So when we have kids, you have life insurance, you have retirement plan assets, you have a home. When you pass away and all of that goes to the kids, Indiana assumes that child is responsible and able to manage their assets at 18. And I'll tell you, I was not very responsible at 18. I would have had some fantastic parties in college, but my money might have been gone. So it's really important to at least put some simple structure in place so that kids can get a feel for having the money and not losing the money. We know statistically people blow through the initial money given to them, regardless of how old they are, how much money they have, or how much they're inheriting. They blow through it in less than 2 years on average. So we don't want our kids to do that. We want it to be there as that safety net going forward into the future. The final thing that I would say, just for tonight, is lots of people have misconceptions about needing a will. Do they have an estate? Do they need a will? And what the state's intestate provisions would be. A young married couple that doesn't have a will might presume that all of their assets would go to their spouse if they passed away. Those assets with beneficiary designations or jointly owned will go to the spouse. Those assets held in that individual's name alone would not go 100% to the spouse. They would go 50% to the spouse, 50% to the children, who might be minors if we have children. We've had estranged children receive some of their inheritance before. That's not always what someone wants. If there are no children, we might think the spouse gets it all then, but they don't. It goes to parents. So a percentage goes to the spouse, 75%, 25% goes to the parents. So it's important to know what the intestate laws are. It's important to know, do I need a will for a guardian? Do I need a will to change the diversion of my assets, of where they're going? And do I need to avoid probate? Probate in Indiana, I know when I first started practicing law, there were lots of firms that did seminars that scared you that probate is evil, probate is horrible, you don't want to go through probate. And I'll tell you, I agree. You don't want to go through probate in multiple states. You don't want to go through probate in a state that has really big fees. I had a $500,000 property go through probate in Florida. It cost $50,000. Probate in Indiana might be finished in 6 months and it might cost $5,000. So probate in Indiana is not evil, but we can avoid probate lots of different ways. You can put beneficiaries on all of your bank accounts. You can put beneficiaries on your retirement account, your life insurance, your house. You can put beneficiaries on your car. You can put beneficiaries on lots of things if we're comfortable with those people receiving it outright. One last thing I'll say on a Medicaid standpoint is when we have a couple and we want to leave assets to a incapacitated spouse. So if we have parents are aging, one of them has Alzheimer's, one of them has Parkinson's, we know they're going to need care. The Medicaid rules, if we want Medicaid, say a special needs trust has to be inside their last will and testament in order to protect those assets under if a death of the healthy spouse were to occur. We didn't cover revocable trust, avoiding probate with revocable trust, and a gazillion other things, but hopefully I gave you a few things to think about tonight.
That's amazing, Tammy. You gave a lot of things and I appreciate it. And I hope that people will be confident to give you a call afterwards to go into those things deeper. Have 1 or 2 minutes. I'll continue with just throwing a question out or maybe a comment. I actually, if I'm correct, you can correct me, obviously. I didn't know before we set up our will and you talked about guardianship, but I think an important point is that you can name a guardian and a person that, and I don't know what the right nomenclature is, but a person that runs the finances separately.
Absolutely. Yeah.
That was really important for us to know, because sometimes the people that will care for your kids the most aren't always they're the best financial stewards. So you can separate those roles if need be.
They're also in a position of conflict. So if the person controlling the funds is the one to decide, do we go to Europe for the summer and do we pay for everybody to go from the child's money? There's a conflict there. Do we add on to the house? Do we buy that high-tech riding mower that the kid's going to lose interest in and, after mowing a couple of yards, So it's good to have the conflict, the lack of conflict there to eliminate that as well. I have people in their wills that will say, this person cannot be guardian. This person cannot have visitation alone. I want my kids to remain together. I want my kids to be able to come back to that home, even while they're in college. They're not under a guardianship anymore, but I want them to have a home base through college. So you can put lots of restrictions on there. Lots of people, almost everybody says, I want them to enjoy visitation with paternal and maternal family members like they would have had I been alive. So, go to Christmas at the other grandparents every now and then and all those kinds of things. So
it's fascinating. Lots of stuff to get into there. Thank you so much for your time and
you're welcome.
All right. Well, rolling right along, we're going to hand the mic over to Aaron Lantine, who is a financial advisor with Thrivent here in town. Aaron, thanks for coming tonight. You're on mute there, buddy.
All right. Thanks, Beau. I didn't ask you this before. Am I able to do a screen share at all or no?
I believe so. It's the box with the up arrow in there if you want to share your screen.
I do that here in a minute if I can figure it out. Yeah, I handle all aspects of financial planning as well as executing on those plans. at Thrivent. It just operating in the same vein as what we've heard of earlier. Taxes is kind of that big hot button, and we heard several good strategies so far on it. And I want to talk a little bit more about some urgency behind it, because we have some pretty significant tax changes coming around the corner here in a couple of years at the end of 2025, when the Tax Cuts and Jobs Act expires. So for businesses, it doesn't expire, but for individuals, it does, and it's going to revert back to tax brackets prior to that law going into effect. So the 2017 brackets. It's pretty huge. It's pretty huge. I'm going to bring a graphic up here that'll show. Let's see here. Can figure this out. Tell me if you can see this little bar graph thing here. Okay.
Yep.
Yeah.
Everybody see this? Okay. So just to give an example, if you have a household married filing jointly that makes $250,000, you can see here where the black arrow is that they're in that 24% tax bracket in today's tax rates. But once these tax brackets expire, that same $250,000 of income is in the 33% bracket. More of the income, as you can see below that, is taxed at a higher rate. And this is something that's not getting a lot of press right now, because it's not something that anybody wants to talk about. Hey, taxes are going up, but they are. And so what do we do about that? How can we take advantage then of these next few years? Well, with a lot of our clients, we're talking about getting monies out of the pre-tax environment. So our 401k contributions, our traditional IRA contributions, all the stuff that's being done pre-tax, that's not taxable on your, each year when you're putting it into those retirement savings vehicles. It feels good not to have to pay taxes on that right now, but what we're doing is we're building this tax bomb that's just getting bigger and bigger and bigger every year, and eventually it's going to explode, or it's got to be diffused. So we want to try to diffuse this as efficiently as we can. So I'm going to shift to a different screen here and show an example of what that might look like. So I have an example of a couple who has about $800,000 of total traditional IRA or 401k type assets, retiring this year. You don't have to do this when you retire. You can do this during your career as well. But let's see here. Another one up here. So here's an example where they have their earned income. Actually, not retiring for 4 years. So there's earned income here in the blue. And then we want to maximize this purple line here, which is their 24% income tax bracket, and try to get as much of their pre-tax retirement assets converted into Roth as possible. And it doesn't always have to convert into Roth. You could just do a distribution if it's going to be spent. But if we want to continue to have it invested and never have to pay taxes on it again, then we can convert to Roth. We've heard a little bit about that earlier. So in this example, they want to maximize this tax bracket. So they took $207,000 and converted that into Roth. A little bit more the next year, a little bit more the following year. Then after 2025, tax brackets shift, change, and you won't be able to convert as much because the threshold for that higher tax bracket is lower. But over the next 6 years, this couple is able to convert all of those pre-tax IRA assets into Roth. And the difference here, if you look over here to the right, with the strategy, 2025 tax bracket is lower. So over the next 6 years, this couple is able to convert all of those pre-tax IRA assets into Roth. And the difference here, if you look over here to the right, with the strategy, 2025 tax bracket is lower. So over the next 6 years, this couple is able to convert all of those pre-tax IRA assets into Roth. And the difference here, if you look over here to the right, with the strategy, There's $5.944 million worth of assets at the end of the day, at the end of their projected plan, compared to 5.4. So that's $500,000 of savings, tax savings over the long haul, by going ahead and shaving those taxes off in the short term. So stop sharing there. Let's see. So in a nutshell, maximizing your tax brackets, paying taxes now or biting that bullet now can save you tons down the road.
Excellent. That's a great presentation. I like the graphics. Didn't prompt you to give them those, so I'm happy that we got some graphics here. That was very informative to me. I'm a visual learner, so that was very helpful. I appreciate that. All right, well, we'll switch gears to Mr. Tim Garrity to wrap us up this evening before we get to the Q&A portion. He's a financial advisor at One Midwest Financial Partners, and Tim's helped my family, my parents, with some elder care situation, long-term care situation. So that's how I know him. And Tim, what do you have for us tonight?
First of all, I have an insight, and I always like looking for insights. And it's great to be invited this and great to hear other professionals. Jeff's insight that I took, you can own your own HSA. Don't have to wait for a company plan. Timothy, backdoor Roth. Again, tax advantages like Aaron was saying. I would love to sit for an evening and listen to Tammy's family stories that she has lived through. I'm sure they're very entertaining. She wouldn't be able to share names, but she's probably seen it all. 18 years old and greater should have power of attorney. That's an insight that most people would go, no. So I really appreciate that. And then Aaron, tax advantages. I wrote down saving tons. Really important. Kind of along those lines, my insight is really more about protecting assets. I do all the things that we've talked about, but I want to look at protecting assets, specifically having money available for our long-term care. So my quote is, if you allocate nothing for your long-term care planning, you allocate everything to it. If you allocate nothing for it, you're putting everything to it. I believe the largest transfer of wealth from our retirement accounts is to communities, facilities, people that help us as we age, in home, in a community. I'm not knocking them. They do great things. They cost money. Have you planned for that? And most people that are just starting a job aren't thinking about retiring. I think we all realize that, boy, this came up on us quickly as we age. And my advice to my clients, think about it now, because it's always on the table. I like using stories to illustrate. My mother and stepfather had $800,000. My mother predeceased my stepfather. Stepfather had a stroke, needed care at home, had another stroke, needed to be in a community, and he progressed through the community. 4 years later, he had $400,000. Now, he had a legacy plan to leave $400,000 to each of his children. It didn't happen. He paid dollar for dollar for his care. He didn't leverage anything. So, and he wanted out every day. Why? He said he couldn't afford it. but he did. But he paid dollar for dollar. That is something people have to consider and think about. We've been talking a lot about tools, and I like the analogy. I have yet to see a financial tool that is not fantastic. But a lot of people will go, well, annuities are terrible. I don't want to use an HSA. I've got something else. My 18-year-old doesn't need a power of attorney. Have you ever tried to hammer a nail in, started in the wall with the back of a screwdriver? Everybody probably has. How did it go? Not well. We don't look at the screwdriver and go, these things are terrible, I'm not using one. No, we realize we use the wrong tool for the wrong job. So I like to really help people understand the financial tool and how it can benefit them. So really there are two things in protecting assets. I like to work with clients preparing for their long-term care now, so they are planning for it. And you can slice off, if you've got your assets, taking a portion of your assets and using the right long-term care, you can protect everything else. For an example, you might be able to take a couple 60 years old, $125,000, and leverage that into about $6,000 a month per person for long-term care. Now that's significant. That's bringing, I like to call it income. That's bringing income into the equation when you need it most. So that's planning ahead. Most people don't do that. And I'm pretty sure Tammy does a lot of these things. Medicaid, a lot of misunderstanding about Medicaid. Medicaid is there for Hoosiers who qualify for it. So this is actually what we helped Beau's grandmother get on. You just have to qualify for it. But if you have, let's take my stepfather, $800,000, he needed care, he would have had to spend $798,000 down to $2,000 before he could have gotten care. There are things to do to protect the money. Tammy was talking about trusts. Now, there will be a penalty for that. So you're going to have to spend some of your money before the government will step in and help. What if you did that money on the front end and your children aren't trying to do it hair on fire on the back end? So that's what I do with Senior Solutions Consulting. We help people on the back end protect assets, get them Medicaid or VA benefits. We do it all through Medicaid's rules, but some people still have to spend part of their money. And the kids don't know for the parents what to do. That's why they rely on financial advisors. Where do we start first? What asset do we start spending down? Oh, wait, that has to be converted. We're paying taxes. Mistakes are made at the end. So I always work with my clients. If you allocate nothing for your long-term care planning, you're allocating everything for it. So that's what I like to help people do, protect their assets and get the care they need.
That's awesome, Tim. I would say the quote came to mind while you were talking, and it's the quote that says, "The people that fail to plan to fail." And I think that could be a theme of tonight. It is so easy to just keep life going, and there's going to be tasks and trials and things happening every single day, and always easy excuse to not contact a professional and seek their help. I'll get to that tomorrow, but unfortunately, like I think Tammy mentioned in her talk, you just don't know what's going to happen tomorrow. And the theme, I think, is really that planning. And I'm hoping that some of the information that hit our clientele tonight and the ones that will watch it on the recording in the future will take that to heart and reach out to you guys. We'll have your information available to all of our database and clients and friends and family, because I truly just want them to plan out their lives accordingly to what they want, and have a chance to live long, healthy, successful lives, and have their families do that as well, their children and whatnot. So because it is a hard thing, I never thought I would be involved with helping my mom help her mom, and it's something that no one tells you when you're at 18 to 30 that you're going to get to enjoy to do, but suddenly you're middle-aged and getting handed the baton of responsibility for your elders and their planning or lack of planning. And so certainly don't want that to be the case for my kids and the future of my family tree. So that's why I feel like these topics are so important. And I appreciate all you guys' time tonight. There are a few people that have joined us, so if anyone does have a question, there's a little hand button at the bottom of your screen, whether you're on a phone or a laptop. If you tap your phone, and we got James Smith has raised his hand, you can jump on, James, ask your question, and we got the greatest professionals in Indy right here to help answer it.
Great, thanks, Beau, and I appreciate all the speakers tonight. It was really helpful. I had 3 questions. Hopefully they're pretty quick questions. The first one, I guess, is directed for Jeff. I have 3 children. They're all kind of young adults. 2 of them are out of college. 1 is still in college. And I had invested over the last several years, and before that in the Indiana 529. I've always kind of invested the maximum to get the Indiana state tax break of $5,000. Did you mention, I wasn't sure if I picked it up, has that gone up to $7,500 this year, or was I mistaken in that? Oh, you're on mute, Jeff.
Sorry, I was working doing tax returns. It's gone up to $7,500 for 2023.
For 20, okay, great.
Yeah, for 2023 tax returns.
So, and if I put the $7,500 in there, I still get 20% of that as a state tax break. Is that what you had mentioned?
That is correct. So it goes up to $1,500.
Excellent. Well, thank you very much for that. Second question is for Tammy. Tammy, again, because I have 3 children, ages 21 and 2 that are 24. I think I never thought about them getting a power of attorney. So that is my next thing. But I guess, where can they go to get that? Is that pretty much only done through an attorney's office that they would get a power of attorney filled out? And you are on mute too.
Thank you.
No problem.
There are lots of services that you can, Quicken Lawyer, anything like that. And it is probably sufficient for your 18-year-old that probably is not going to need their power of attorney. We like lawyer drafted documents better because the statutory presumed, the presumptions in the statutory power of attorney aren't totally broad. So if you needed to do Medicaid planning, the statutory power of attorney might not give you the authority to do all that you need to do with that planning. Okay. So healthcare power of attorney, healthcare representative, durable power of attorney, those are important documents if they have assets to deal with, or if they had a medical situation to deal with. My daughter, when she turned 18, said, "I know what you're going to tell me, Mom. You're going to tell me I have to come into the office and sign a power of attorney." And I said, "Well, you're right."
Yeah, gotcha.
But I've drilled it long enough, I guess.
Great, thank you. That's helpful information. The last question, I don't know that anyone addressed, and I don't even know if it's an issue that needs to be addressed. My 2 older children who have now gotten jobs and are full-time employees, and they're looking at benefits of their companies. I'm with my company, and I have to take my health insurance through my company, and it has to be for my spouse and my children, because I still have one that needs to be covered under that. When my children are getting their jobs, if they are able to kind of decline their health insurance because that way they don't have to pay the premium and still be on my account until they're 26, I have been advising them to do that simply because why would they want to pay for it when my health insurance plan is better than the ones they're being offered, and I already have to pay for the family plan? Is there any sort of missing a loophole that I'm missing that might benefit them taking their own health insurance from their company? That makes sense as far as a question?
I can take that. I'd say the benefit would only be for them to do it themselves would be they're going to learn. They're going to learn what their health insurance is. They're going to learn how to pay the medical bills.
Gotcha.
And that knowledge is invaluable. From a dollars and cents standpoint, what you've recommended, they do what I did for my adult kids as well. So
Okay.
our oldest daughter just went off. She just turned 26 in January and just went off of it. Our next son, he's 22. He's still on it. He still gets all his bills. You know, when he does go to the doctor, he gets the bill. It's not coming to me, but he's not having to pay those premiums. And since we have younger kids still at home, when you're paying for that medical plan, and you've got your spouse and then at least a child, adding more children doesn't make your premium go up.
Yeah.
So, you know, it was no difference to us to have them on there. So we did the same thing. So that just kind of validates what you're doing. But I'd say the only other benefit for them doing it themselves is I think they would probably learn more and
Yep.
hopefully become responsible.
I agree with that. That's a good one.
Yeah, they could also start their HSA earlier because they would have an individual HSA. And I think it would come down to how much of the premium is the employer paying. So how much extra cost are they assuming in order to do all this early? I probably would keep my daughter on until she's 26 as well, just because health insurance is outrageously expensive wherever we pay it. So why pay extra?
Yep. Great. That was my questions. And again, thank you everybody for doing this tonight. It was very, really helpful. Thanks, Beau.
Thanks, James. All right. We have a couple other people on. Give you a couple seconds here if you want to speak up or raise the virtual hand. We got Sean queuing in. Go ahead and unmute Sean and ask away.
Okay. I recently have, I was working at a prison for 13 years, and then I end up having to take an early retirement because of disability. And of course, I have to juggle the deductible income from a third-party long-term disability and Social Security, and also money coming in from the North Carolina state retirement system through the long-term disability. And my question is, I mean, is there a way to actually secure any of that income coming in so it's not counted against me? I mean, can I actually take some of that money and put it in a secured account or something that won't be counted against me, you know, when I actually have to account for all my money coming in? I don't know who to address that to.
I would like to clarify, Sean. Are you saying on a year-to-year tax accountability basis? Is that
Well,
asking?
No, it's because it is it's actually money that's coming in through like third-party insurance, long-term disability, and it actually counts against. You know, I actually have to sit there and juggle from one financial institution or the one that actually is providing the money coming in, and they have to balance it out to like 60% of my total income of what I was making. And so between the three of them, they have to sit there and balance it out. And I'm trying to figure out, you know, if there's a way to actually secure any of that so it does not actually count against, you know, one of the other financial institutions.
Yeah, it's probably your Social Security that got started
Mhm.
and reduced your private disability insurance. Most private disability contracts have a provision that you have to apply for Social Security disability when you're on
Mhm.
long-term disability,
Right.
and that they get to offset that income that you have coming into you from Social Security disability from what they've promised to bring you up to. They shouldn't be counting your pension as part of that income. That is not earned income, disability income. That shouldn't offset your disability income. But the contract, the private contract, your employer contract is what's going to tell you what income gets offset. You can't
Okay.
really divert it to a different account and not have it be offset if the contract provides for that offset.
Yes, it's actually not retirement yet because my long-term disability, I'm getting that through the state of North Carolina. That's actually coming out of the state retirement system because I'm only 57. And so when I come retirement age, then it'll actually switch over to retirement. But at the time, I mean, I'm also getting 10% disability from the VA, and I'm thinking that maybe something that I could use that I could set aside, put it in a, because we actually had to use my 401k to actually move from North Carolina to Indianapolis, and so we really don't have much in the way of anything building back up because of restrictions on what I count as earned income.
Aaron, you raised your hand there. Did Tammy say what you were going to say, or do you have something to add?
Well, I was just thinking from a tax perspective, the difference between different types of disability policies. If you are you receiving any from like a private disability policy, or is it all like a group disability policy?
Yeah, it's actually third party long-term disability, North Carolina, and also Social Security, and then not disability, but it's actually 10%. Well, I guess it's 10% disability through the VA.
Okay. Yeah, I was thinking before Tammy answered that you were talking about from a tax perspective, that income being accountable.
So from a tax perspective, would disability income count to allow him to contribute to a Roth retirement account or an IRA, or does that not count as earned income to make the deposit? I don't know the answer. I'm asking.
No, that's not what I was referring to either. I was talking about like if a disability policy is the premium that paid into it is with pre-tax income, like a lot of our employers, when they have a group disability plan, they pay into it. We're not taxes on that premium, so the benefit that comes out would be taxable. However, like you said, a third-party policy or a private policy that you got through just an insurance company somewhere, you're funding that premium with after-tax money. Therefore, the benefit is completely tax-free, just like life insurance proceeds would be.
Okay. Okay.
Well, Sean, that's complex. I'll say that. You probably know better than anybody since you're living it. But
well, I used to have hair before that. Now I had to pull it all out because I had to deal with all this. It's maddening.
Well, I'll make sure and follow up and connect you with some of these professionals, because I don't know that we got your question completely answered, but I know they're all happy to help continue that conversation. So,
well, I appreciate. At first I didn't know what I was going to get out of this, but I appreciate all the input, and it's actually very helpful and gave me a lot of information. So I do appreciate it.
Yeah, thank you so much, and that brings us to the top of the hour. So I'll just wrap it up and say thank you again. I honestly said and thought to myself as I was listening to all of you, how blessed I am to have the relationships I do here in Indianapolis, to bring together like a powerhouse group of people, and the minds and knowledge that you guys have acquired over the years. It's incredible. I would have done this years sooner had I realized how amazing you guys would sound on this call. So thank you so much for everything you've done for me and for my client space and for all the people that'll see this in the future. I think it's very informative. And I'm just going to say have a good evening. I'm going to flip up my screen to put your names up here for everybody to see here at the end, and anyone that needs your contact information is welcome to reach out to me as well. Thank you, everybody.
Thank you, everybody.
Good night.
Good night.
Night.